Yeah,
Congratulations to Spain for winning the most boring World Cup finals ever.
So my daughter got dropped. We dropped her off yesterday at a place in Stevens Point, Wisconsin called Camp Shutout, and it is one of the nation's premier, if not the nation's premier goalkeeper camp. So she's going to be just nothing but goalkeepers. She's going to get her, what handed to her all week long. That's great. But the first thing they did is they started by getting everybody together in a big room at the conference center and watching this World Cup. And one of the things they also had is one of the sponsors had us guess who was going to win. And I overshot it. We predicted Spain. I overshot it, thinking 2-1. But I'm honestly not shocked that it was 1-0. For those of you that are listening, spoiler, sorry. But these two teams, that's how they play. They just control the middles. I told someone, I think the way Spain and Argentina, but specifically Spain, reminds me of American football. Okay, so France is the team. It's the Big 12. Sorry if you're a Big 12 fan. It's the old Big 12 conference. Lots of receivers, quarterback, flashy plays, driving the ball down the field, the air raid. They got the kicker in Mbappe, right? Spain is the team that grinds it out. It's like Indiana last year. They just grind it out. You can't take them down. It's all in the trenches. Offensive line, defensive line. Old Georgia, Alabama. That's Spain. And sometimes it's not fun football to watch. But I'll tell you what, you can't get it through the mids. You can't get any shots on goal. And that's been Spain now going for 36 consecutive wins, something like that. Euro Cup winner. Nobody can get anywhere with them. And then something breaks. So boring, yes, unless you're just really into the technicals of watching football. Now, I will say this, and then we'll get back to everything else that matters. The third place game was the opposite. That was awesome. Big 12 football. And but honestly, if you watch it was just bad soccer.
Yeah. Yeah, it was.
Terrible.
But it was fun to watch.
For all that Europeans talk about their talent, maybe on their first tier, but their backups look like some of the most average MLS players I've ever seen. I have no idea what France's goalie was doing first half, coming out, running around like he just had no idea where he was and what he was doing. Anyway, that game, sure, you like scoring, great, but terrible play. Anyway, I move on.
Yeah, it was good to watch the consolation round. The finals I wanted to see was Spain England. That's the one I wanted to see.
Was what?
Spain and England. I wanted England to be in the finals. I was disappointed when Argentina got it, but
yeah, I think we would have saw a different English team than we saw in that third place game for sure.
Yeah, I mean, but I like the way England played the World Cup. I think they played well. They were fun to watch. I think Spain and Switzerland were the most two boring teams of the World Cup that I saw, and I was Argentina it was like the JV team was out there. Their goalie was phenomenal, but it was like the JV team. They didn't touch the ball once. I think they got one shot on net. I mean, it was horrible. So whatever.
But that's what Spain does to everybody. I mean,
I know.
They're incredible.
Which is, I mean, it's soccer, and this is one of the things I don't like about soccer. It's kind of like watching golf sometimes, and that's kind of, I don't know, it was boring. Anyway, but either way, congratulations to Spain for winning. Now we got to wait another 4 years. Which I think is really dumb on their part economically. I mean, if you want to talk about economics, they should at least do it every 2 years.
Like the Ryder Cup?
Yeah, I mean, 4 years is way too long. I mean, I don't know why.
But we got Women's World Cup in 2 years.
I don't know if this is the first time they did a consolation round, but it feels like if you're trying to monetize soccer, do it every year. Why are you waiting 4 years? It's ridiculous.
Yeah.
But
it is not, by the way, because I remember them talking about the third place winner in the last World Cup too.
Did they?
Yeah.
Okay. I don't remember watching it. Maybe it wasn't worth watching, but either way.
Yeah, but we got Summer Olympics, we got Women's World Cup, so we'll have more ways to entertain our insatiable appetite for sports. So
Women's World Cup, so the U.S. has a chance.
That's absolutely do. And I don't know if so this is a good transition to the economics of it. For those who haven't heard, the men, I believe the U.S. men got something like $16 million for the team for their performance in the World Cup. So for anybody who thinks that they're just playing for the glory of their national their national name and colors, no, this is definitely high paid. This is a business. But the U.S. men share that pot 50-50 with the U.S. women. And the U.S. women will share their pot 50-50 with the U.S. men. So they've got a kind of an economic system there where both teams benefit from the performance of the other team in the World Cup. So
well, I think the men will make out better in this one. The women the women dominate in soccer, so kudos to them. But I don't know. World Cup's a little different, but if you're talking about like, you know, the NBA versus the WNBA, there's a reason the women get paid less. It's because no one understands. I mean, let's call it what it is. I know a lot of people want women to get paid more. It's like, well, fill the stands. I mean, I'm not against equality, but equality of economics is communism. So it's not how things work.
We've got one of the best WNBA teams right here in my backyard with the Minnesota Lynx. And my daughter went to one of those games the other day. And she said, like, she's dad, it was really interesting. It was quieter. I mean, it wasn't as flashy. It's kind of like women's golf. The fundamentals, their shooting technique's better. Just like in women's golf, they tend to have a better short game. But unfortunately, it doesn't draw the fanfare, and the feedback is often. It's just you can see the difference in athleticism overall. And if you're looking for that big, high profile, it's just not going to compete on the same level. It is what it is. I mean, so
and that's the struggle. I mean, I understand. I feel for the women, but there are some sports that women dominate, and there's some sports that men dominate in terms of interest, public interest, and soccer for women is one of them. I mean, kudos to women for soccer. I mean, it's awesome. I'm glad that they're doing so well, and wish them luck in their own World Cup. But
and the last thing I'll say on this, I think if you get a sport where you can look on screen and it looks similar, like women's volleyball, they actually lower the net a little bit. Completely competitive, high-paced game, fun to watch. Women's golf, you can't tell the difference. They're still driving the ball, putting it in. And I think another example is women's soccer, right? It's a soccer ball. They kick it. Basketball, the women are still playing on a 10-foot hoop. I mean, bring the hoop down a little bit. See the women's slam dunk? You might see a little bit of a difference of where you can actually say, hey, they look similar. But as long as it's structured the way it is, you can tell it's different. Where in other sports like volleyball, soccer, golf, there's a way of making it look like, hey, they're playing the game at an equal level. So,
well, I'm not an expert on the Olympics, but I can tell you I've never seen men's beach volleyball, but I see women's beach volleyball on TV all the time. I wonder why that is.
I do watch men's beach volleyball. It is good, and man, they play very, very well. But yes, I am definitely glued into the women's beach volleyball.
I wonder why women's is always on prime time, and the men's you have to hunt for it.
I wonder why, Kirk.
I'm not going to say the reason, but it's just curiosity.
The things that we'll ponder.
I wonder what brings in the money, Doug.
The Socrates moments of sports. Anyway, moving on. Carry us in.
That's all right. It's all good. It's all good. Cool. So let's kind of dive right in here. And we're in the summer doldrums once again, and apparently we're officially back to war. It's hard to tell.
Who thought that was going to happen?
Who would have thought? I think we're officially at war, according to Trump. I think he's got a 60-day window or something like that. I don't follow all the technical rules because it doesn't really matter. It's just kind of like people are, you watch the news. I don't watch the news, but every once in a while I see these clips and people are like, well, officially he's got 60 days and blah, blah, blah. Like, it doesn't really matter. Trump doesn't care. Like, Trump's doing whatever Trump's doing. And war, not at war. I mean, we've been at war since March. And even though officially, hey, it's over. It's like when George Bush, landed on the deck of the aircraft carrier, and he's like, mission accomplished. I'm like, yeah, sure. 20 years later, like, okay. Yeah, I think it's all theater. You can't put too much stock into this stuff. All you can really do is just watch the market and say, what does the market think? And when March happened, the markets didn't immediately react because, quite frankly, they didn't they didn't believe it was going to be a long drawn out thing. But eventually the market dropped like, I think it was like 12% from like the peak where it was before. And then as of April 1st, war's over, and quote unquote war's over. And then the markets shot up, and then they were up 10% for the year, which is like, a little shy of 20%, point to point. And now the market's dropped a little bit back down because apparently we're back at war again. This is, oddly enough, I did not expect us to be a war this year. That was not something I predicted, but I did predict that the markets would be very volatile, and more or less they would be kind of flat. And we'll see if the markets go back down to flat. I mean, the summer tends to be kind of a rough period. If you think of like, sell in May and go away, that has been a long time theme on Wall Street. And starting in May until about October, starting in October till May is the best period. And from, although not typically in October, but, after October and really after May, if you really want to get into the numbers. So it's June, July, August, September, October are the bad months. And then you got, November, December, January, February, March, April are the good months. And so if you look at that and you say, all right, what are the best months to invest? Although February is typically not great and July can be okay. But if you really want to look at, where the markets are, I'm not too excited about the markets. I'm just not. I think that, if you look at the markets, just take like the S&P, for example. I'm going to bring up a chart here, just kind of like show the S&P. But if you look at the S&P right now, for the last few months, we pretty much have, let's see here. There we go. So this is the S&P for pretty much since May. It's in a range. It's in a range from 72.40 to 76.20. And, I don't know what it is right now because I haven't looked in the pre-market, but basically we're in this range. And I expect we'll probably continue to be in this range, which means a whole lot of nothing is going to happen. Now, this range is large enough, right? It's a 5% range, looks like, somewhere right around maybe 6.5% range. But, the reality, so if you really look at it, okay, so we get to the bottom of the range and the S&P is only up like 3% for the year. It's boring, right? A lot of people are like, oh my God, this is going up. Okay, great. Good luck to you. If you want to fight this market, good luck to you. If you want to go all in, good luck to you. Until it breaks out of this range, up or down, there's nothing to do. You're just biding time. You're better off just sitting in cash until it breaks out of this range because nothing's happening. Now, for those of you who are like, oh my God, the S&P, okay, great. Now there are stocks that are doing well right now and there are stocks that are not doing well right now. And we'll talk about that a little bit. But generally speaking, this is a whole lot of nothing. This is, hey, let's go to the beach, right? That's what you do with that chart. Let's go to the beach and pretty much forget about it. Now, if you look at this one, it's a little bit of the same. This one is the S&P. It just goes back further for the year, right? So the first box is where we were prior, and then it broke out, and then we're in another box. And that's what will happen again. It may be up, it may be down. We don't know yet, right? It's most likely going to be up, but we don't know. Something bad could happen. Trump could, nuke something and whatever. I don't know what's going to happen. But I think we're going to probably see a lot more of the same in the Middle East. We're going to have strategic bombing, and they'll send some missiles back, and we'll send some missiles back, and blah, blah, blah. And, no major targets are going to be hit. It'll be a lot of strategic stuff. And I think it's frankly a continuation of what's happened since March, but whatever. It's out in the open that we're bombing people. So, that tends to be what happens in markets. And if you look at the NASDAQ from September until March, it pretty much went nowhere. Even though a lot of stocks and a lot of sectors doing really well, for the most part, the big tech went nowhere. And right now we're kind of back into that place. Big tech did really well. Not let me rephrase that. Not big tech, but AI did really well. Software didn't do well. Software is still in a rough spot. I would say a really rough spot. I do think that, if you look at earnings season, we'll get in, touch on this, so I'll send it back to Doug. But if you look at earnings season, you really have financials which actually are pretty strong. So if you think about like what's important, and so because we're in earnings season, it's a really good indication of the economy. How's the economy doing? Okay, it's really important. A lot of people look at the market like, oh my God, the market is doing terrible. We must have an economic recession, or the market's doing great and we must be doing great. It's not always the case. Okay, we could have great earnings, and the market go nowhere. We could have terrible earnings, and the market, goes down. It's not necessarily reflective. Now, one good indication of the economy is the banking sector. Okay, the financial sector, the banking sector is a really good indication of the economy. Because if we have a lot of bad debt, a lot of bankruptcies, a lot of non-performing loans, then the banking sector gets hit. If we have more lending and there's growth, it means the economy is growing. It's a really good indication. It's not always, it's not perfect, but it's a good indication. And the banks right now have actually reported really good earnings. Pretty much all the banks had solid earnings. That's a good indication of the economy. So we said this a few weeks ago. We said, look, the economy is actually pretty strong. Regardless of what the stock market is doing, the publicly facing economy, let's put it that way, because you go to the private, it's different. But in general, if you look at the big banks, they're reflective of the publicly traded economy and some of the private. The regional banks are maybe a little bit more reflective of the private. But if you look at the big banks, things are great. Right? Things are great from the big banking perspective. JP Morgan, profits are up 41%. If you look at, if you look at some of the other banks, not quite so much, but they're still pretty good. Netflix was weak. United Health, rose a bit with a big beat. But, if you're looking at, this coming few weeks, there's going to be some more big earnings. I don't have that in front of me, but basically, if you're thinking about the markets, don't expect there to be a crash based on earnings. It's just not going to happen. Also, there's not going to be a crash based on the banking sector. Not going to happen. Now, are there some weak points? Yeah, absolutely. In the software sector, not very good, right? People are very concerned about the software sector. If you look at if you look at private credit, right? If you look at the private side, where the funds are lending instead of the banks. It's a little bit more questionable. It's not terrible, but you're definitely seeing some signs of question, especially in the software sector, especially with AI. But I do think that AI will be an indication of whether we go into recession or not. I think the next recession will be due to what happens to AI. If AI goes in the doldrums, we're toast. If AI continues to stay above water, we'll be fine. I really do think it comes down to that, because so much money is being spent on on AI, that if that stops being spent, where's it going? I don't know. So it's a big question. I do think that this administration is going to be very supportive, maybe even investing in AI. I think OpenAI has been asking publicly for Trump to invest in their company, which to me is a really bad sign of their stability as a company. When you want the government to invest in you, that is a really bad sign. You can't do it on your own. Hey, Dad, can you lend me some money? Can you invest in my company and come work for me? It's just not a good sign for OpenAI. I would not touch that with a 10-foot pole. Just, now, granted, you could be doing really well as a company and still ask that, which is what big companies do, because when the government invests, then the government has incentive to keep you going and to support you. So I'm not liking where it's not an indication of the AI sector. I personally, I think we're way overvalued. I wouldn't touch it. Not to say there's not future profits there. I have no interest. There's other areas of the market that are interesting, but AI, from my perspective, is not one of them. So I don't know. What are you seeing this week, Doug? What's on your list of interesting things for you?
Well, I'm gonna start with what you just talked about with AI, and a reminder. You mentioned something with regards to United Healthcare, and and it kind of led into what's the impact of AI, and of course open AI then trying to like ask for funding. There's two things that I thought from that. Number one, United Healthcare continues to rally, and this is a reminder that again, nothing is flawless. Listen to me, nothing is flawless when it comes to uh, indicators or opportunities that exist and appear in the market. Okay, so this is not a science that you should just follow blindly, but I will tell you that I made some positions in United Healthcare because remember, United Healthcare was struggling really badly about a year ago. And the stock went absolutely into the toilet. And I think that was especially leading into the earlier parts of this year. One of the first things that I looked at, Kirk, and this is something that has been an indicator that you can look at for whether or not a stock might make sense to invest in. Again, are we buying the dip, or are we just dollar cost averaging, which are two different things? And if you're going to buy the dip, is it a good time to buy the dip? Does the stock look like it's going to be something that's going to continue to go down further? And maybe maybe something bad is happening. It may go down a little bit. You think, oh, it's a great buying opportunity, but it's the beginning of chaos. Or is this, pullback something that is overshot, a legitimate pullback for the fundamentals? United Healthcare is a perfect example. Okay. Our healthcare system isn't going anywhere. The one big beautiful bill came and basically took away a lot of subsidies. There's going to still be a demand for healthcare in the United States. Our healthcare system hasn't changed. And guess who the greatest provider of healthcare in the country is, especially for profit? It's United Healthcare. And so when it tanked earlier this year, there is one of the things you can use as an indicator of whether or not it's a good idea to invest in a stock is insider activity. Okay. Now, this is a one directional indicator. Okay. Because some people say, well, oh my gosh, the insiders are selling. That's a good reason to get out of a stock. Insiders will sell a stock for any number of reasons. Okay. They might have options that are going to expire. So they buy them. They're exercising them, diversify. There's again a number of different reasons that they might buy that has nothing to do with whether or not the outlook for that company that they have shares of is in a state in which the insiders are trying to get out of. But on the other hand, insiders, which have a lot of access to the data that's going on in their company. They have a lot of access to the outlook. They know what their future projected earnings are going to be before they give it to Wall Street. That's why they have to report these things. They are going to know, is this stock something that's a good time to buy, or is this a good or hold? Should we just kind of hold steady on it? And United Healthcare insiders were buying up United Healthcare stock after that stock went down. Okay, that's an indication when insider buyers, not just one or two, because sometimes you get a new director that might have, might have now just gotten some options, maybe new compensation package. But when you see a pattern of multiple insiders executing purchases on a stock, especially after a stock may have pulled back, it, again, not on an island, but it can be an indicator that they're looking at it and almost laughing, like, I can't believe what happened to the stock. We're jumping on this because this is completely undervalued. And this is one of those situations where the healthcare structure of the United States didn't change. So their stocks get beat up. Guess what stock is going to benefit from the fact that we all are going to continue to need health insurance? United Healthcare. And you're seeing that since then, it's been a tremendous rally on their stock price from where it clearly now, hindsight 2020, completely pulled back too far. Insiders bought into it. And that, again, is something to watch. If you ever see a stock pull back heavily, watch what the insiders are doing. Don't go crazy. It is not the only indicator you should be looking at. But if they are, for the most part, buying it up, could be a good indicator that, hey, this stock at least has some bounce possibility, that it may have moved too far. Now, I want to come back to OpenAI for a second. It reminds me a little bit of what we've been talking about the last couple of weeks, SpaceX. Okay. What have I talked about SpaceX? It's doing exactly what I said it was likely to do. Here is 75% of IPOs are less value than their IPO a year later. SpaceX came out astronomical, historically high valuations, and fundamentally inside, you've got some fundamental things. Their rocket department's is actually doing really, really well. They've gotten very efficient at that. Obviously, we have Starlink that is wildly profitable. But what did they throw into their company, Kirk? Or if you're muted.
Sorry, yes, I am muted. What do you mean? What are they throwing into their company?
What did SpaceX throw into their company? Like one of their biggest divisions. What is it in? What is it focused on?
Starlink?
No. So we got Starlink rockets. What's the third one? What's the biggest one? What's
AI?
The drag? AI. OpenAI. X and XAI. This is what is fundamentally sucking the wind out of every other unit in SpaceX. And like you said, OpenAI is going to the government saying, hey, can you invest in us? We need money. Coming into the IPO, SpaceX was going out to places like Fidelity. Just a little concept of how IPOs work. A select group of investment bankers get to buy out that company and then decide what that share price is going to be and distribute it. It's called the syndicate to their, generally who wants to get it on the IPO. It's going to be their loyal customers. A lot of their high net worth customers are going to get access to this. And if a company is going IPO at the right value, the right price, they're going to get enough investment from their higher quality investors to get all the money they need. Okay. They're not going to open it up to retail. They're going to let their investors turn around and sell it to retail later. SpaceX was coming into the IPO already with stories of, hey, we're going to open this up to Fidelity or certain brokerages where you can invest in the IPO for $2,000 minimums. I'm sorry. There's no reason that they want anybody like that to come in and purchase this stock right out of the gate on the IPO, unless it's exactly what OpenAI is facing. And that is, we can't get enough liquidity coming in from our original group of investors. It's a sign, and we're seeing it right now. SpaceX stock price is absolutely plummeting, and it is now not a surprise to me, less than it was at the value of the IPO, and it looks like it's going to be a stock that's probably going to be lower. 6 months from now, there's going to be opportunities where maybe the valuation is going to make more sense, but clearly, AI is a big catalyst in the excitement of what these companies have to offer. But it is incredibly expensive. It is an absolute capital drain to keep up with the bandwidth and the processing. And so from that aspect, I think that any of these AI companies, as exciting as they are, they're going to have a really hard time being profitable anytime in the foreseeable future. Now, I want to move on to a couple of things in the last week. Obviously, we saw a pullback in the S&P. It dropped 1% on Friday. It erased some midway gains. Despite a temporary inflation cool-off, the NASDAQ slid 1.4. It was weighed heavily by 2.9% drop over the final two sessions. There's some more in that. And then the Dow lost a little bit. But from the Dow, what we're starting to see in there is that there's beginning to be a massive factor rotation from growth to value. Good for you, Kirk, because I know you're a fan of value. And everybody's been waiting on value for a long, long time to come and actually have some success. The last 6 months of the year, we're finally starting to see a little bit more of that balance there. Clearly, we've got some shocks to the system with U.S. and Iran energy, war happening, not happening, this happening. Yeah, right. President Trump announced another maritime blockade of Iranian shipping through the Strait of Hormuz. That caused West Texas Intermediate crude futures to skyrocket 16% over the week to settle at 82.49 a barrel, which again is at least nicer than it was a couple months ago. But unfortunately, it pushed the price of an average gallon, the average gallon of regular gasoline over the $4 mark again. And if you are unfortunately living in some areas like California or Illinois, and you're dealing with the summer blend, which is always more expensive, that's continued to be a real pain point for you, and you're probably seeing well over $5 a gallon in some of those areas. Fed policy tension. This is, again, we're trying to figure out what's going to happen with the new Fed chair. The energy shock caused expectations for a July Federal Reserve rate hike to collapse further. However, some initial conversation from Kevin Warsh warned Congress that the battle against inflation is far from over. We've got, going back to AI, China released something called the Kimi, K3 model. It's a moonshot AI. It unexpectedly released its open source large language model, and it sparked deep fears that cheaper competitive foreign options could halt the domestic AI infrastructure spending boom. Again, another reason to be very concerned about AI. There's valuation jitters. There's been massive capital expenditure updates, such as TSMC lifting 2026 spending forecast to 60 to 64 billion. That shifts market focus from strong demand to massive future capital requirements. And then we had a chip whiplash this past week. Market darlings, NVIDIA, Intel, Micron, AMD, sharp tech pullbacks. Apple, Microsoft actually briefly shielded the mega caps. Apple temporarily reclaimed the market cap crown at 4.91 trillion before it flipped back. Nice to see Microsoft doing okay for once, because they've been hit pretty hard over the last 6 to 12 months. But Apple just seems to continue to float there as almost as at least a temporary store of value these days. And just no matter what happens, we've talked about it. I don't love the fundamentals, but Apple's still, the name, the value, the history there continues to hold it up. Mega banks, earnings season beneath the surface. You were talking about the earnings. Mega banks outperformance. So major financials like JP Morgan Chase, Goldman Sachs, Bank of America, they broadly beat expectations. They were propped up by lucrative Wall Street trading desk calls. So lots of trade. I have a chart out there that I think again is a concern that we're seeing. The demand for leveraged ETFs is at a record pace. They've been skyrocketing. Leveraged ETFs means that you have investors, in this case, generally going to be retail, just screaming to find ways to continue to get outpaced returns. You can't, if they're not getting it on 1x type of multiple type of investment, Kirk, they're going to go out there and they're going to start chasing higher multiples, 2x, 3x through leverage. Dan, this does remind me of this, irrational exuberance. It reminds me a little bit of, of the Joe Kennedy and the taxi cab. Again, when you start chasing more and more and more and taking an exponential amount of risk to do it, it does set up a greater potential for a black swan event to have everything come crashing back. Okay, this, the reach for leverage, the reach for the demand for more returns, that is something that is generally long-term bearish. Big tech earnings are flashing yellow. Next, Netflix created over 7% on weak revenue guidance. IBM triggered alarms with warnings slowing enterprise AI spending. Again, concern. And retail metrics remain mixed. Now, on the Domino's Pizza surged 7%. They beat second quarter revenue goals, proving value-centric consumer models are holding tight. That's I'm more of a consumer staple type of mindset. There's some new charts also coming that are tracking massive tech correction and corresponding energy shocks. There was, the crude oil was up, NASDAQ, 100 down. There's a high growth sell-off hitting tech-heavy NASDAQ 100 index, along with a sharp defensive spike in energy commodities as this geopolitical escalation takes center stage. Again, if we start, I think the thing that we need to keep watching is that in contrasting these tech losses with this massive 12% surge in energy is the thing that drives everything. Every single thing, and it always is the case. If energy remains expensive, everything else is going to be a little bit more difficult. to maintain, because energy is priced into everything. It's the shipping to get it there, it's the manufacturing, the plastics, all of that ties to petrol. This stays elevated. It also makes the Fed have some very difficult decisions ahead.
All right. So I'm going to go over a few charts here and some charts from last week, and then kind of share, performance of the markets. I did want to share this one because Doug had mentioned it, which is the SpaceX chart, which looks like a rocket landing, not something you want to invest in. But this is the example of like what we talked about before. I mean, it went public at like 150, approximately hit around 225, and right now it's at 125, 123. So it is what it is. 122 as of right now. Look, I mean, they're gonna have employee shares that they're gonna be able to liquidate, and I don't know when that exactly is. There's some dispute about when that is. Usually 6 months, but there's some talk that it's going to be 3 months, so I don't really know. But either way, I'm not going to touch it until we see some signs that things are bottoming, and that could be a lot lower, which should be a great opportunity for patient people. And so hopefully, as a listener to the show, you've been patient and you can wait for opportunities to buy it at a reasonable price. If you think it's going to be a great investment, then it's a great idea to wait. Just like Facebook, when before they came out with their ad model, it just dropped like 40%. Great opportunity to buy, and it's been a great investment since. If you did that, so you don't have to invest in everything. I know it's a headline and people want to say they own it. It's a great idea just to own it at a good price. You'll be much happier. That being said, I did want to share a few charts here because I think we've been talking in the last few weeks about the markets and why they're wrong. They're not wrong in the sense that, I'm right and they're wrong. They're wrong in the sense that they're not operating in a normal way. And I want to make that distinction because most people say, oh, the markets are broken or the markets aren't doing this. Yeah, that means you're wrong, right? Because price is the ultimate arbiter. Price is right. I hate to say that phrase, but the price is what's right, not your intellectual thinking about it. So yeah, the markets, the S&P's up, great. It's all due to AI. It's the only thing driving the performance. Okay. It's still the index price. It's still the way it is, but understanding why it's there is why we talk about it, right? Because ultimately, if it's up, it's up, even though to me, intellectually, I don't love the construction of the S&P. I think it's terrible. I think you've got, basically 7 stocks driving, like, I think it's like 10 stocks drive 40% of the performance of 500 stocks. It's ridiculous. It's stupid. Like, why is it even an index? Why do we even pay attention? Why not just follow the Dow where there's 30 stocks that drive it? And it's not even the 30 stocks. It's based on price. So what's the biggest allocation? I think it's Goldman Sachs because they have the highest number, like in their stock price. It's not because they're the biggest. There's bigger companies, but the fact that their price. So if everybody's like 100, I'm just making this up because I don't have it in front of me. But if every stock is $100 a share and Goldman Sachs is $300 a share, then they've got a lot bigger allocation because of the price. But that's not the market cap. The market cap is how much the company is worth if you were to buy it. That's more important, right? What are the biggest companies in the world? Apple, Nvidia, Microsoft. Those should be the biggest allocations if you're going to do it that way. But no, it's based on an arbitrary number. So these indexes, I think, are garbage. There are better indexes you can look at, but generally speaking, what you want to understand is everybody's looking at the Dow, everybody's looking at the S&P. By the way, the Dow is a terrible index. Don't look at it. The only reason that people talk about the Dow, so if you're doing this, just take this with a grain of salt. If you're watching the news, which you shouldn't watch because it poisons your mind, but let's just say you're watching the news, what are they going to talk about? They're going to talk about the Dow. Why? Because it's got the biggest number. What's more interesting, 6,000 or 50,000? Well, 50,000 is a bigger number. Let's talk about that. Oh my God, the Dow went up, $1,000, like 1,000 points today. It's like, okay, that's 2%. That's not, but the fact that they could talk about bigger numbers, it's big news. No, it's not. It doesn't really matter. So, if you talk about, well, in the biggest crash, the Dow went down like 700 points. Okay, that's like a daily price move now because the numbers are higher. So once you understand like we call them half truths. So once you understand the half truths that Wall Street talks about, you understand the game. They're just gaming you. It doesn't really matter. So here's what does matter. Here we're gonna kind of walk through a few charts here to help understand what's going on in the markets and why it matters to you. Okay. Because the reality is a lot of this stuff, like the index does matter, but you need to understand why things are happening. Okay. So this chart shows high beta versus low beta. Well, what's beta? Well, beta is basically, I'm trying to simplify this. It's basically volatility. So a low beta stock might be a utility company, right? It's basically a bond. A high beta stock might be like an AI stock, right? Or something that's really, really volatile. Now, if you look at high beta, clearly it's outperforming the index. If you look at low beta, clearly underperforming the index and has been for many, many years, has been since 2020. Now, this is a theme that frequently happens in markets, right? Things operate normally, then they don't operate normally. And that's okay, right? I'm not here to justify whether it's right or wrong. I'm just telling you, you need to understand the trend. So if you start to see this, you say, okay, can this continue? And should I jump on the bandwagon? Just important to understand, right? So the fact is high beta is doing well, low beta is not doing well. Okay. And this aligns with many things. Here's another one. Biggest semiconductor rally in 30 years. This is quite clearly what happened after the war ended. Semiconductors went through the roof. The war, quote unquote, ended. And I should even put the war in air quotes. But anyway, so this is a semiconductor index up 88% in Q2. It's kind of crazy. Even in the tech bubble, the highest was 68. So, that's not normal, right? Normal is like 20, 30%. Okay, that's not normal, but it's normal-ish. This is completely abnormal. I'm going to skip that. Oh, here's a newspaper quote from 1990. And to put this in context, this is when people thought, well, Warren Buffett, he's an idiot. We just put all our money in tech stocks. They're going up 100%. Warren Buffett's an idiot. Well, to put it in context, from 1998 to 2000, the NASDAQ surged 75%. Over the same period, Berkshire Hathaway lost 18.9%. What? That's a difference of almost 100%. So the NASDAQ is up 75% over a 2-year period. And over the same period, Berkshire lost almost 20%. Well, clearly, Buffett lost his touch because for 2 years, it was down and everybody was putting their money into tech stocks. There's a ring to that seems very, I don't know. It's very similar to what we're going through now, isn't it? Fairfax, which is people call the owner, I'm trying to blank his name, Watsa, I think. Prem Watsa, I think is his name. He's like the Warren Buffett of Canada. Basically, Fairfax Financial is a Canadian insurer, and he's like the Warren Buffett of Canada. Like a very good investor, very smart.
Prem Watsa.
Yeah, Prem Watsa. Okay. Yeah. So Warren Buffett underperformed by 94%. Fairfax was down 64%. 64%. While the NASDAQ's up 75%. Underperforming by 139%.
Idiots don't know what they're doing.
Yeah, clearly they're morons, right? We're us individual investors who are putting all our money in AI and Bitcoin and all these things. We're the smart ones. So the point being is, when you start to see things like this, when you start to see a clear discrepancy between smart people and everyone else, it makes you think, okay, maybe I am not that smart. You should be thinking, isn't that interesting? Or more importantly, what am I missing? Now, Warren Buffett has been out of touch for the last 20 years, just to be clear. He's he's made a lot of mistakes in the last 20 years, and he's retired. But point being is he lost his touch along the way. But this is back before that. This is in the 90s when he was on point. He was very smart. Since then, he's made a lot of errors, in large part because of the size of Berkshire. You can't go buy a See's Candy anymore. You got to buy like the largest companies in the world, which case you really don't have alpha anymore. So I think, there were some clear errors made, but regardless, he's a very smart guy. Let's just give him that. And when you see people, he's been largely in cash for quite a number of years. He's had a large portion of cash, which he did have before the financial crisis as well. So anyway, we're moving on here. So quality versus momentum. Momentum is like high beta, trying to simplify it, and quality is like value stocks. So they've been underperforming. Value stocks have been underperforming, which is what you would expect, right? Momentum is more, hey, I'm going to buy the hot dot. It's just something to keep in mind that clearly value has been underperforming and the hot dots have been taken off. Here's another indication. Momentum is clearly, taking a record pace. Here's the S&P by price to sales ratio. 51% of the price to sales ratio is above 10. If you're not familiar with price to sales ratio, I would go look at I don't have the charts here. I would go look at the historical price to sales ratio, but above 10 is quite high. You have more than half the S&P is above 10. That's not a good sign. That's not a good sign. So I'll bring back next week the kind of more historical, but I also wanted to bring this up because the last 2 weeks you've been talking about it. If you've noticed at the gas pump, your gas prices have not gone down, even though oil prices went from a high of 120 down to 68, whereas prior to the war it was 66. So even then, you still had like $4 or $5 a gallon gas. And here's the reason. It's what's called the crack spread. We're running out of time, so I don't have time to get into it. Maybe we'll get into this next week. But the crack spread is basically the refining profit. And so when you have a large crack spread, you have a lot of profit going to refiners. It's not always large. It tends to be in these spikes where oil prices go up and down, and you have to give them time, because if oil prices are 120 and then they drop to 60 overnight, let's say, what's going to happen is you still bought oil at 120. So you still have to process that at 120, right? And vice versa. If you bought it at 60, you still have to process that at 60 before you buy 120 if it went up. So there's still stuff in the pipeline. So there's a reason why things take time. But regardless, huge profits for refiners, and they're making hay right now. So that's one of the reasons. I also want to point this one out. I saw it the other day. I thought it was interesting. So if you want to understand, like, is the market healthy? This is not a healthy market. Okay. What this is basically saying is the S&P is going up with the Fed balance sheet. So let's not draw conclusions here, but there's a high correlation between how much money the Fed is increasing their balance sheet and the S&P. I wonder what's going on there. So when this chart is going up, it means the S&P is moving up on its own. It's healthier. And when it's flat, it means basically the balance sheet is effectively pushing up the S&P. I'm not saying that's the truth, but there's a very high correlation there as to that is happening. So it's a good thing to keep in mind. Is the market healthy or not? Is it due to the Fed or not? Just something to keep in mind. I thought it was interesting. And the last one I want to share is frontier markets. We don't usually talk about frontier markets. They're really hard to invest in. But if you kind of look at valuations, it's an interesting place to look at opportunities. Obviously, some of these areas are really hard to invest in. But in the Asia, Vietnam, Philippines, Indonesia, you can invest in some of those. Europe, not so much. But yeah, it's hard to invest in frontier markets. It actually used to be an ETF, a frontier market ETF, and then they closed it right at the exact time when it was a good time to invest, which is usually what happens. But anyway, back to you, Doug. I know we got to wrap it up here.
Yeah. So I want to come back to that S&P Fed balance sheet chart again next time we talk. It's a legitimate chart. There is some definitely tech, and you kind of alluded to it. It's correlated. It's not exact. There's definitely some textbook shark crime stuff that, that comes into that too. The other thing I want to talk about for next, hopefully for next time is you talked about not healthy. There's three things I'm not going to get deep into, but I mentioned it already. The mechanical back in the stock market is flashing major systemic liquidity warning signs, retail demand for leveraged equity exposure, fever pitch, leveraged market cap is soared to an all-time high of 200 billion per Bloomberg. Banks are struggling to facilitate massive daily rebalancing flows for leveraged funds. Equity repo funding markets are facing tight conditions as leverage demands drain dealer balance sheets, and a sudden market downturn forces mechanical daily selling, compounding downside momentum. Number two, we've got extreme institutional complacency. Despite these geopolitical oil shocks and severe semiconductor pullbacks, professional money managers are refusing to play defense. And so if you're just sitting there kind of passive allocation with your money, and especially if it's a professional manager or you're doing it yourself, be cautious. We have a 7-year sentiment low. A percentage of fund managers stating U.S. equities are overvalued just hit a 7-year low. According to the data that's out there, that's a head scratcher. Institutional FOMO is happening. Professional money allocators are completely trapped in a performance chasing cycle despite visible macro cracks and severe position risk. There's been minimal defensive hedging. That means broader market remains highly vulnerable to unexpected downside risks. And the last thing, AI capex debt strain. Equity investors focusing entirely on AI revenue guidance. The fixed income and the credit markets, this is where it tells you the truth. They are pricing a much darker reality regarding how this infrastructure boom is funded. Credit default swaps for hyper-cap infrastructure spenders like Oracle are surging higher, not slightly, surging. There's a $5.3 trillion question. Big tech is aggressively tap dancing on debt markets to fund these unproven data center builds. And ultimately, fixed income desks are beginning to penalize massive corporate balance sheets over heavy capital expenditure. So be careful there. And so I just, to wrap it up today, listen, I want to leave you with something that goes beyond these market headlines. The real story may not be Iran, may not be oil, may not even be artificial intelligence. The real story is, what are investors being trained to do? For years, people have been told, buy the dip, stay fully invested, don't miss the next rally. But increasingly, this has turned from investing into chasing. We're seeing it. Retail investors are pouring record amounts into leverage ETFs. It's not simple buying stocks. It's borrowing exposure to stocks, trying to double or triple this daily movement of the market. And the question is why? Because a normal return no longer feels normal. A 7% return feels boring when someone online made 40% in a month, or we've seen 22% returns in the last 2 years, which is not normal. Owning a diversified portfolio, that feels distracting and disappointing when 3 AI stocks carry the market. Patience, that starts to feel like failure when everyone else is getting rich faster than you are. And that is one of the most dangerous psychological shifts in investing. Leverage doesn't simply increase returns, it accelerates mistakes. And leverage ETFs, they don't wait for investors to calmly reconsider. When markets fail, they rebalance mechanically. Selling creates more selling. Losses force decisions. What looks like confidence on the way up can become panic quickly on the way down. Same time, we've got very strange signals between the surface. We got real interest rates are nearing the highest levels in years. Credit default protection, more expensive for some of the companies spending the most aggressively on AI infrastructure. Oil's rising, geopolitical risk increasing, and yet investors say, give me more risk. And it tells me something. This market isn't being driven only by optimism. It's actually being driven by fear. Not fear of losing money, fear of missing out. We're in a massive FOMO situation. Those are not the same thing. Fear of loss usually makes people cautious. Fear of missing out makes people reckless. And it convinces investors that price doesn't matter, valuation doesn't matter, risk doesn't matter. As long as someone else is willing to pay more for tomorrow, that's where the old price is right rule comes in. The goal is not to guess the highest possible price. The goal is to get close as possible without going over. For the markets today, they seem to reward the opposite behavior. Don't think, don't question, keep bidding. AI spending higher, valuations higher, leverage higher. And eventually the argument becomes the price must be right because the price keeps rising. The price is not your proof. The price is simply what the next buyer agreed to pay. We saw that with SpaceX. The story didn't suddenly become terrible. Rockets didn't stop working. Starlink didn't disappear. But the stock dropped because expectations outrun reality. And that's the part investors forget. A great company could still become a bad investment when there's too much greatness reflected in price. And the same thing with AI. AI may transform this global economy. It doesn't mean every AI stock is worth the price. It doesn't mean every data center is going to be an acceptable return. It doesn't mean borrowing money to chase yesterday's winner is a financial plan. At Emergent Advisors, this is why we don't begin with the question, what should we buy next? We begin with a more important question, what does your money actually need to accomplish? Because when you know what you need, you don't have to chase what everyone else wants. You don't need leverage to make an ordinary return feel exciting. You don't need every hot stock. You don't need to predict the next SpaceX, the next NVIDIA, or the next market correction. You need a plan that connects investments to retirement income, to taxes, to family, to estate, to college goals, and ultimately the life you want to live. If your portfolio has become more aggressive because the market kept rewarding aggression, that may be worth examining. If your expectations have risen because prices have risen, that may be worth examining. Because the greatest price risk is not going to be a rising market, and it isn't always losing money. Sometimes it's just forgetting how much risk you're taking. Visit us, emergentadvisors.net. That's MERGENT, MERGENT, emergentadvisors.net. Because hope is not a financial strategy, confidence is. And confidence comes from knowing, not chasing. And I'll leave you with this. When everyone is focused on getting the highest return, the smartest investor may be the one asking whether the return is worth the risk. And sometimes the most important investment decision isn't what you buy next. It's deciding you no longer need to chase it.
Awesome. Well, thanks for coming on, Doug. And that's the show for this week. Thanks again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisory Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week around the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out our show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a share rating and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think, but investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.